ExamPrep.School. Wyoming Life and Health Insurance Exam, Exam Code 12-WY-5 or OP-WY-05. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Health, field underwriting procedures. Health, other insurance concepts. Health, policy provisions, clauses, and riders. Health, social insurance. Health, types of policies. Life, application, underwriting, and policy delivery. Life, policy riders, provisions, options, and exclusions. Life, retirement, and other concepts. Life, types of policies. Statutes and rules common to all major lines. Statutes unique to accident and health. Statutes unique to life. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which statement accurately distinguishes participating whole life policies from non-participating whole life policies? A. Participating policies feature guaranteed dividends and fixed premiums, while non-participating policies establish flexible premiums based on current surplus. B. Participating policies share the insurer's divisible surplus through non-guaranteed dividends, whereas non-participating policies guarantee cash values but pay no dividends. C. Participating policies ensure a fixed dividend scale, but lack a guaranteed death benefit, while non-participating policies guarantee both death benefit and cash value growth. D. Participating policies permit the policyholder to adjust premium payments using dividends, whereas non-participating policies require the policyholder to pay a single premium. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer accurately identifies that participating policies entitle policyholders to share in dividends from divisible surplus, while non-participating policies provide guaranteed cash values without dividend distributions. Reason A is not correct. Participating policies do not guarantee dividends, and non-participating policies do not base premiums on surplus fluctuations. Reason C is not correct. Participating policies do guarantee a death benefit, and non-participating policies also guarantee cash values, but the dividend scale is not fixed. Reason D is not correct. Dividends may reduce future premiums, but participating policies typically use fixed premiums, and non-participating policies are not single premium by design. Question 2. Which characteristic best describes a limited pay whole life policy? A. Premiums are payable throughout the insured's lifetime, with annual adjustments based on mortality experience. B. Premiums are paid over a specified period, after which the policy is fully paid up and coverage continues until death. C. Policy matures at the end of the premium paying period, and the maturity value equals the accumulated cash value. D. Premiums stop after a specified period, and coverage automatically converts to a term policy thereafter. The correct answer is B. The correct answer describes that limited pay whole life policies require premium payments for only a defined period, after which no further premiums are due and benefits remain in force for life. Reason A is not correct. Limited pay policies do not adjust premiums annually. They are fixed for the payment period. Reason C is not correct. A limited pay policy does not mature at the end of payments. It remains whole life coverage. Reason D is not correct. Coverage does not convert to term. It remains whole life once fully paid. Question 3. Under U.S. tax rules, a single premium whole life policy is automatically classified as which of the following? A. A modified endowment contract, because the single payment exceeds the 7-pay premium limit. B. An indexed life policy, due to the immediate allocation of cash value to market-linked accounts. C. A variable universal life policy, since it involves a one-time premium deposit. D. A simplified whole life policy, because premiums are less than standardized mortality charges. The correct answer is A. The correct answer recognizes that a single premium structure triggers the MIEC rules by exceeding the 7-pay test, subjecting distributions to additional tax treatment. Reason B is not correct. Indexed life policies are defined by their interest crediting method, not premium structure. Reason C is not correct. Variable universal life involves flexible premiums and investment risk, not a single lump sum payment. Reason D is not correct. Simplified whole life refers to underwriting, not premium payment timing or tax classification. Question 4. For an endowment life policy with a maturity age of 95, what occurs if the insured survives to that age? A. The policy pays the contract's cash value as a living benefit at age 95 and coverage terminates. B. Coverage continues until death, but no living benefit is paid at age 95 unless specified in a rider. C. Premiums are waived after age 95 while the death benefit remains in force until age 100. D. At age 95, the endowment converts to a paid-up whole life policy with reduced face value. The correct answer is A. The correct answer reflects that endowment policies pay their face or accumulated value upon reaching the designated maturity age, ending coverage. Reason B is not correct. Endowment contracts specify a living benefit at maturity, so a payment is required. Reason C is not correct. There is no waiver of premiums after maturity. Coverage ends with the benefit payment. Reason D is not correct. An endowment does not convert to paid-up coverage. It terminates upon maturity payment. Question 5. David, age 45, holds a universal life policy with a level death benefit. Option A. The policy face amount is $300,000 and the cash value is currently $45,000. At the next policy anniversary, the cash value increases to $50,000 and he then elects the increasing death benefit. Option B. What will be the death benefit amount immediately after the election? A. $295,000. B. $300,000. C. $350,000. D. $345,000. The correct answer is C. The increasing death benefit, option B, equals the face amount plus the accumulated cash value. After the cash value grows to $50,000, adding this to the $300,000, face amount results in a death benefit of $350,000. Reason A is not correct. Subtracting the cash value from the face amount is not correct for an increasing death benefit. Reason B is not correct. Maintaining the level face amount applies to option A, not option B after the switch. Reason D is not correct. Multiplying or otherwise misapplying the cash value does not yield the correct option B death benefit. Question 6. Emma has a universal life policy with a guaranteed minimum interest rate of 3%. The insurer's current declared interest rate for this period is 2%. Which statement best describes how interest will be credited to Emma's policy cash value? A. Credit the declared rate of 2%. B. Credit the guaranteed minimum rate of 3%. C. Credit the average of the declared and guaranteed rates 2.5%. D. Credit the sum of declared and guaranteed rates 5%. The correct answer is B. Universal life policies credit the higher of the declared interest rate or the guaranteed minimum rate. Since the declared rate is 2%, which is below the 3% guaranteed minimum, the policy is credited at 3%. Reason A is not correct. Crediting only the declared rate ignores the policy's guaranteed minimum floor. Reason C is not correct. The policy does not average the declared and guaranteed rates for crediting. Reason D is not correct. Summing declared and guaranteed rates does not reflect how universal life interest is credited. Question 7. Which provision in a level term life insurance policy allows the policy owner to renew the term coverage each policy anniversary without providing evidence of insurability, with premiums recalculated based on the insured's attained age. A. Convertible term option. B. Guaranteed insurability rider. C. Annual renewable option. D. Level premium guarantee. The correct answer is C. The correct answer is the annual renewable option because it permits renewal each year without proof of insurability and charges premiums based on the insured's current age. Reason A is not correct. Convertible term option is wrong because that allows conversion to permanent coverage, not annual renewal. Reason B is not correct. Guaranteed insurability rider is incorrect because it provides options to purchase additional coverage, not simple renewal. Reason D is not correct. Level premium guarantee is wrong because it locks premiums over an initial period, not annual rate adjustments. Question 8. In a decreasing term life policy designed for mortgage protection, which of the following accurately describes how the death benefit changes over time? A. It remains level while the mortgage balance decreases. B. It is payable only to the lender if the insured is alive when the term expires. C. It increases annually to offset rising mortgage interest. D. It decreases on a predetermined schedule to match the mortgage amortization. The correct answer is D. The correct answer is that the death benefit decreases on a predetermined schedule to match mortgage amortization, ensuring coverage equals the outstanding loan balance. Reason A is not correct. Saying the benefit remains level is incorrect because decreasing term policies reduce coverage over time. Reason B is not correct. Payable only upon term expiration is incorrect since the death benefit is paid if the insured dies during the term. Reason C is not correct. An increase to offset interest is wrong because the benefit is designed to decline, not grow. Question 9. A return of premium term life policy includes a refund schedule that provides the policy owner with which of the following benefits if the policy remains in force to the end of the term? A. A partial premium refund upon surrender prior to maturity. B. A refund of premiums paid if the insured dies during the term. C. A predetermined percentage of premiums returned at term expiration. D. A guaranteed reduction in future premiums after a set number of years. The correct answer is C. The correct answer is a predetermined percentage of premiums returned at term expiration, as stated in the refund schedule of return of premium policies. Reason A is not correct. A partial refund upon surrender is incorrect because the refund schedule applies at term end, not on surrender. Reason B is not correct. Refund upon death is wrong because the death benefit is separate from premium refunds. Reason D is not correct. Guaranteed premium reduction is incorrect since return of premium schedules do not reduce future premiums. Question 10. Which feature best describes the exchange provision in a convertible term life policy? A. Permits exchanging term coverage for a new term contract with higher benefits upon renewal. B. Allows switching term coverage to a permanent policy at specified times without evidence of insurability. C. Authorizes the insurer to require insurability evidence at the time of conversion. D. Limits the exchange privilege to instances where the insured is below a certain age at death. The correct answer is B. The correct answer is that the exchange provision allows conversion to a permanent policy at specified times without requiring evidence of insurability. Reason A is not correct. Exchanging for a new term contract is wrong because the provision covers conversion to permanent policies. Reason C is not correct. Requiring insurability evidence is incorrect since conversion privileges waive that requirement. Reason D is not correct. Limiting exchange by age at death is incorrect because age limits apply at conversion, not at death. Question 11. A 30-year-old purchased a 10-year level term life insurance policy with a guaranteed renewable provision. up to an attained age of 65. At what attained age will the insured lose the right to renew coverage under the policy? A. At age 66. B. At age 65. C. At age 70. D. At age 95. The correct answer is B. The correct answer is age 65 because the guaranteed renewable provision allows renewal only through the specified attained age, after which renewal rights terminate. Reason A is not correct. Age 66 is beyond the limit. The coverage right ends as soon as the insured reaches the specified attained age. Reason C is not correct. Age 70 exceeds the stated renewal limit and would not be permitted under the guaranteed renewable provision. Reason D is not correct. Age 95 is a typical maximum in some contracts, but does not apply when the policy specifically limits renewals to age 65. Question 12. A 35-year-old insured originally bought a 5-year level term policy that included a re-entry option. At the end of the level term period, the insured is in excellent health and wishes to renew at the lower original premium rates. Which requirement must be met to exercise the re-entry option? A. Provide satisfactory evidence of insurability. B. Submit a detailed financial statement. C. Pay an additional re-entry fee. D. Complete a new application without medical examination. The correct answer is A. The correct answer is that satisfactory evidence of insurability is required to renew at the original lower premium under the re-entry provision. Reason B is not correct. Financial statements are not the focus. Re-entry depends on health status, not financial status. Reason C is not correct. No extra re-entry fee applies. The provision hinges on insurability rather than a surcharge. Reason D is not correct. A new application without exam would lose the original rate. Proof of insurability is required. Question 13. Under which federal statute must the separate accounts of a variable life insurer first register with the Securities and Exchange Commission? A. Securities Act of 1933. B. Securities Exchange Act of 1934. C. Investment Company Act of 1940. D. Investment Advisors Act of 1940. The correct answer is C. This option is correct because separate accounts are treated as investment companies under the Investment Company Act of 1940 and must register accordingly. Reason A is not correct. This statute governs securities offerings but does not require separate accounts to register as investment companies. Reason B is not correct. This act regulates secondary market trading and reporting, not initial registration of investment companies. Reason D is not correct. This statute regulates investment advisors, not the separate accounts themselves as investment companies. Question 14. Variable life insurance separate accounts allow policy owners to direct premium allocations among distinct subaccounts primarily composed of which investment types? A. Equity and debt portfolio subaccounts. B. Guaranteed fixed interest accounts. C. Insurer general account investments. D. Third-party managed mutual fund shares. The correct answer is A. This option is correct because separate accounts consist of subaccounts invested in equity and bond portfolios, with policy owners bearing investment risk. Reason B is not correct. Fixed interest accounts are part of the general account and not the variable separate account structure. Reason C is not correct. General account investments are pooled with other insurer assets and not allocated via separate accounts. Reason D is not correct. Separate accounts hold portfolios managed by the insurer rather than external mutual fund shares. Question 15. Which definition best describes the participation rate in an indexed universal life policy? A. Maximum interest rate that may be credited. B. Index value used for point-to-point calculation. C. Guaranteed minimum interest rate during negative performance. D. Percentage of the index gain credited to the cash value. The correct answer is D. This option is correct because the participation rate determines the portion of the positive index return applied to the policy's cash value. Reason A is not correct. This describes the cap rate, which limits maximum credited interest, not participation rate. Reason B is not correct. This refers to the index measurement method, not the percentage credited. Reason C is not correct. This describes the floor or guaranteed minimum rate, not the participation rate. Question 16. Jim owns an indexed universal life policy with a guaranteed minimum interest rate of 1%. In a policy year when the underlying equity index returns negative 5%, how much credited interest will accumulate in the policy's cash value? A. 0%. B. Negative 5%. C. 1%. D. 4%. The correct answer is C. The correct answer is that the credited interest is the guaranteed minimum rate of 1%. So despite a negative 5% index return, the policy still credits 1%. Reason A is not correct. Zero interest is incorrect because the policy guarantees a positive minimum rate rather than zero when the index is negative. Reason B is not correct. Applying the negative index return is wrong since the guaranteed rate prevents any cash value loss due to market declines. Reason D is not correct. An interest of 4% is incorrect because the guaranteed rate does not increase by the amount of the negative index loss. Question 17. During a stock market downturn, what factor primarily causes the cash value of a variable life insurance policy to decline? A. Reductions in the insurer's declared interest rate. B. Expirations of policy loan grace periods. C. Increased cost of insurance charges. D. Poor performance of the separate investment accounts. The correct answer is D. The cash value in a variable life policy rises or falls in direct proportion to the gains or losses in its separate investment accounts. Reason A is not correct. Interest rate declarations relate to universal life policies, not the investment-driven cash value of variable life. Reason B is not correct. Loan grace periods affect loan interest, not the investment-based fluctuations in cash value. Reason C is not correct. While insurance charges reduce cash value over time, they are not the primary cause of sharp declines during market downturns. Question 18. Under a typical waiver of premium rider on a life insurance policy, premiums are waived after the insured has been disabled for what standard qualification period? A. 3 months. B. 12 months. C. 9 months. D. 6 months. The correct answer is D. The standard qualification period for most waiver of premium riders is 6 months of continuous disability before premium waivers apply. Reason A is not correct. A 3-month waiting period is shorter than the typical 6-month qualification period required. Reason B is not correct. A 1-year period is longer than the usual 6-month qualification period for premium waiver. Reason C is not correct. A 9-month period exceeds the standard 6-month requirement outlined in most waiver of premium riders. Question 19. A payer benefit rider on a juvenile life policy typically waives premium payments if the payer becomes disabled or dies until the juvenile insured reaches what age? A. 18. B. 30. C. 25. D. 21. The correct answer is D. Most pay or benefit riders on juvenile policies waive premiums until the child reaches age 21 if the payer becomes disabled or dies. Reason A is not correct. Age 18 is legal adulthood, but most contracts specify waivers until age 21. Reason B is not correct. Age 30 is well above the common expiration age of 21 for juvenile policies. Reason C is not correct. Age 25 extends beyond the standard expiration age for payer benefit riders. Question 20. Under a standard accidental death benefit rider, death must occur within how many days of an accident for the insurer to pay double indemnity? A. 90 days. B. 30 days. C. 180 days. D. 365 days. The correct answer is A. Accidental death benefit riders generally require that death occur within 90 days of the accident to qualify for double indemnity. Reason B is not correct. A 30-day limit is shorter than the typical 90-day period required for double indemnity. Reason C is not correct. A 180-day limit exceeds the standard 90-day maximum period under most AD and D riders. Reason D is not correct. A 1-year period is far longer than the usual 90-day requirement for accidental death benefits. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.